Welcome to my channel. I am going to walk you through the process of valuing 4 utility stocks and analyze their financial ratios. Become a member of the channel and I could do a more in-depth valuation, or we could do a private Zoom session where I show you how to analyze financial statements and answer any questions. See the link in the top of the description. The first company we're going to look at is Evergy. Evergy is an investor-owned utility company. The company was formed from a merger of Westar Energy of Topeka and Kansas City Power and Light. Evergy is the largest electric company in Kansas, serving more than 1 million customers. Let's get started with the model. This is a large cap company, 11.4 billion market cap, so that's the value of the company according to the stock market, and they trade at $50 a share. And to get shares outstanding, it's market cap divided by stock price gives you shares outstanding, 227 million. We're going to need this number later when we calculate the value of the company. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. Free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are investments in property, plant, and equipment. You usually want to invest in a company with positive free cash flow, because if a company has positive free cash flow, then they could pay dividends, pay down their debt, acquire other businesses, or invest in their own business to grow it. If you invest in a company with negative free cash flow, it can't do any of those things. This company has positive free cash flow in 3 of the 4 years. In 2016, it does have negative free cash flow. This can happen if you invest in your company, if you buy property, plant, and equipment, because when you invest in PP&E, the cash goes out the door in full. So maybe 5% of the cost of the product will appear on the income statement each year, but the entire amount is pulled out of free cash flow in that year. Over time, it does equal out. A company can also have negative free cash flow if they're selling on credit, which means they're delivering product or service to customers and booking that revenue onto the income statement, but they're not receiving any cash for it. In the future, they'll receive the cash. Another reason for negative free cash flow is if a company bought on credit in the past, used accounts payable, but is now paying for that now in the current year. Net income is on the income statement. It's revenue minus expenses. And this company has positive and growing net income, so that looks really good. When a company has positive and growing net income, that means they're doing a good job managing their expenses. Their revenue has grown quite a bit, from 2.5 billion to 5.1 billion. Their margins are really steady from year to year at 13%. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. The higher your expenses, the lower your net income and the lower your net profit margin. I would expect a company to have higher margins as their revenue increases, but they're steady, which isn't bad. Let's look at a capital structure. They have $10 billion of debt. They pay 3.76% interest on their debt, and cost of debt is 3.29%. To get cost of debt, it's interest rate times 1 minus the effective tax rate. And 54% of the capital structure is debt, which means 46% is equity. To get the cost of equity, we use the capital asset pricing model, and that comes at the 5.16%. Part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. They have a really low beta, 0.37. So the stock moves 1/3 of the market. The lower the beta, the lower the cost of equity. And their WACC is 4.15%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimate a terminal value, which is all cash flows past year 4, that's 14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 227 million shares. And we get a calculated stock price of $59. They're trading at $50, so they're trading at a 15% discount. It's a buy according to the model. Simply Wall Street has them at $57, so almost exactly what I have. Let's see where the stock has been trading the past few years. So the stock price broke through $70 in March, but it looks like it's at a pretty low point. It could be a really good value if you feel the company is going to continue putting up these nice numbers. Let's look at the financial ratios. They don't have such a good PE. The median for the market is 16.7, the average is 18.6. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 17, so investors are paying $17 for $1 of earnings. Price to sales is good. The median is 2.0, the average is 4.8. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 2.2. So investors are paying $2.20 for $1 of revenue. They have a good price to book. The median in the market's 2.4, the average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 1.3. So investors are paying $1.30 for $1 book value. They have a good interest coverage ratio. The median is 4.1, the average is 13.5. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 3.2. So they can cover their interest payments. EBIT is earnings before interest and taxes, also called operating income on the income statement. They have a low ROE. The median is 13%, the average is 15%. ROE is net income over equity. I like to see above 20%, they're at 8%. So they don't provide a good value to the equity holders. Equity is total assets minus total liabilities on the balance sheet. They have a low current ratio. The median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2, they're at 0.6, so they cannot cover their current liabilities, which means they may need to take on more debt. The best way to look at ratios to compare them to similar companies, I've done videos on Alliant, Next Era, both in the same industry as Evergy. And if Evergy has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are the best of the three companies in PE, price of sales, price to book, and current ratio. They are worse than average in ROE, worse in debt. They're the smallest of the three companies, but they do pay the highest dividend. They have a 4.11% dividend yield. So to summarize, I have them trading at a 15% discount. Their ratios look pretty good, and their financials look decent. The second company is FirstEnergy. FirstEnergy is an electric utility company. It's involved in the distribution, transmission, and generation of electricity. It's one of the United States' largest utility company. In July 2020, a few politicians were accused of accepting $60 million in bribes from FirstEnergy in exchange for $1.3 billion worth of benefits. The stock price of the company plummeted within hours of the arrests. These are the type of things you can't really predict. A company can be flourishing and stock price can be going up, but then something like this happens and it could kill the stock. But people forget pretty quickly. Their market cap is $15.5 billion, so they're a large cap company. They're trading at $28.60 a share, and they have 542 million shares outstanding. Their financials look a bit weak. They have positive free cash flow in 2 of the 4 years. They have a big negative in 2018. The net income also looks a little bumpy. Negative net income in 2 of the 4 years. And their revenue keeps going down. So it doesn't look so great so far. They have $21 billion of debt. They pay 4.5% interest on their debt. And the cost of debt is 3.7%. They're a bit leveraged at 75% debt, which means they're at 25% equity. Cost of equity is 4.39%, and we use the beta to figure that out. They have a really low beta, 0.27, so the stock moves 1/4 of the market. Their WACC is 3.88%, which is a blend of the cost of debt and cost of equity, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. That's $13 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $13 billion. We divide that by 542 million shares. And we get a calculated stock price of $24. They're trading at $29, so they're trading at a 19% premium. It's a sell according to the model. Simply Wall Street has them at $34, so they're saying the stock is a buy. Let's see where the stock has been trading at the past few years. So the stock was trading well over $50 a few months ago, but it's been cut in half. So if they do turn things around, it could be a really good value. It can be a little risky because now the light is on them after the scandal. Let's look at the financial ratios. They have a weak PE, that's stock price over earnings per share. Price of sales is good, that's stock price over sales per share, they're at 1.4. Good price to book, that's stock price over book value per share, they're at 2.2. Their interest coverage ratio is a little low, that's EBIT over interest expense, they're at 1.9. ROE is also a bit low, that's net income over equity, they're at 13%. They don't have a good current ratio, that's current assets over current liabilities. They're at 0.5, so they can only cover half of their current liabilities. The best way to look at ratios is to compare them to similar companies. I've done videos on AES, Canadian Utilities, Dominion, and Public Service, all in the same industry as FirstEnergy. And if FirstEnergy has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are better in PE, price to sales, and price to book. They're doing worse in current ratio, a little better in ROE, worse in debt, worse in market cap. They do pay the highest dividend. They have a 5.5% dividend yield. The average is 4.5%. To summarize, I have them trading at a 19% premium. Their ratios look decent, but their financials are a bit weak. The third company is Alliant. Alliant is a holding company whose subsidiaries generate and distribute electricity and natural gas in Iowa and Wisconsin. Let's get started with the model. This company has a market cap of $12.8 billion, also a large cap company. They're trading at $51 and they have 249 million shares outstanding. Financials look pretty good. Free cash flow and net income are positive and consistent each year. Their revenue seems to be growing little by little each year, and their margins are improving. They go from 11% to 15%. So they're doing a better job at managing expenses and becoming more efficient. They have no debt. They're 100% equity. Cost of equity is 4.9%. We need the beta to figure that out. That's the volatility of the stock. And they have a really low beta, 0.34, so the stock moves about 1/3 of the market. And their WACC is 4.9%, which is the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $41 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $36 billion. We divide that by 249 million shares. And we get a calculated stock price of $147. They're trading at 51, so they're trading at a 65% discount. It's a strong buy according to the model. I'm at 147. Simply Wall Street's at 194. Even more undervalued according to them. Let's see where the stock has been trading the past few years. The stock was trading around $60 in March. That was its peak. It's come down a little, but it still seems pretty low, at least relative to the valuation. Let's look at the financial ratios. Not the best price to earnings and price to sales, but a good price to book. Price to earnings is stock price over earnings per share. They're at 23. Price to sales is stock price over sales per share. They're at 3.5. Price to book is stock price over book value per share. They're at 2.5. They have a low ROE, that's net income over equity, at 11%. Current ratio is also pretty bad. That's current assets over current liabilities. They're at 0.4. And the best way to look at ratios to compare them to similar companies, I've done videos on Evergy and Next Era, both in the same industry as Alliant. And if Alliant has a number in green, they're better than the average. If they have a number in red, they're worse than the average. A little better in price to earnings, a lot better in price to sales. They're about average at price to book. A little worse in current ratio. They have the highest ROE. They have no debt. They're the only company of the three with no debt. And in terms of market cap, they're in the middle of the three companies, also in the middle of dividend yield. So to summarize, I have them trading at a 65% discount. Their ratios look okay, but their financials look really good. The fourth company is Public Service Enterprise Group. It is a diversified energy company established in 1985. Its largest subsidiary is a regulated gas and electric company in New Jersey. Let's get started with the model. This is a big company, $27 billion market cap. They're trading at $54 a share, and they have 500 million shares outstanding. Free cash flow looks pretty bad. It's negative in 3 of the 4 years. But net income looks okay. It's positive and growing. So the company is leaking a lot of cash. Revenue looks pretty good. It's growing each year. And they have $16 billion of debt. They pay 3.5% interest on their debt, and cost of debt is 3%. They have 52% debt in their capital structure, which means they have 48% equity. Cost of equity is 6.6%, and we need the beta to figure that out. They have a low beta also, 0.56, so the stock moves half the market. And their WACC is 4.77%, which is a blend of the cost of debt and cost of equity, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $56 billion. We divide that by 506 million shares, and we get a calculated stock price of $112. They're trading at 54, so they're trading at a 52% discount. It's a buy according to the model. Simply Wall Street has them at 125, so they're also saying the company's undervalued. It's a buy. Let's see where the stock has been trading at the past few years. So the stock price was driven up for about 3-4 years, then took a real big dip. It's come up a lot since the bottom. It's getting close to its all-time high. It still could be a really good value. The company does need to generate some positive free cash flow. Let's look at the financial ratios. Decent PE and price to sales, and a good price to book. PE is stock price over earnings per share. They're at 16.2. Price to sales is stock price over sales per share. They're at 2.7. Price to book is stock price over book value per share. They're at 1.8. Good interest coverage ratio, that's EBIT over interest expense. They're at 4.1. ROE is a little low. That's net income over equity, 11%. Current ratio is a little low as well. That's current assets over current liabilities. They're at 0.6. And the best way to look at ratios to compare them to similar companies, I've done videos on AES, Canadian Utilities, Dominion, and FirstEnergy, all in the same industry as Public Service. And if Public Service has a number in green, they're better than the average. If they have a number in red, they're worse than the average. So they are better in PE, a little worse in price to sales, a little better in price to book, worse in current ratio, about average in ROE. They have the lowest amount of debt of all the companies. They're a little higher than average in market cap, and their dividend yield is lower than average at 3.67%. Average is 4.5%. So to summarize, I have them trading at a 52% discount. Their ratios look decent, and their financials are a bit weak. So become a member of the channel, and I could do a more in-depth valuation, or we could do a private Zoom session where I show you how to analyze financial statements and answer any questions. See the link in the very top of the description. Thanks for watching.